Welcome to ZZ Financial. We are committed to providing the most accurate, valuable, and timely information and analysis.
And we are certainly going to need that commitment today. It is now 1:00 a.m. Eastern Time, 10:00 p.m. Pacific Time on Saturday, November 22nd, 2025.
And we are just closing the books on a week that felt, less like trading and more like an emergency evacuation.
That's a good way to put it,
Yeah.
especially from those high-growth sectors, the ones tied to the Japanese market and, of course, global AI.
The instability was just extreme. The force of that sell-off in Tokyo seemed to just spill over into global sentiment. It created this real atmosphere of anxiety.
It really did.
So our mission today is a deep dive into the two big engines of this chaos. On one side, you have Japan's increasingly aggressive, some people are even saying reckless fiscal policy.
Right, the policy that's triggering this massive triple sell-off.
Exactly. And then on the other side, there's this unsettling, almost structural volatility that's gripping global AI stocks.
Where these incredible euphoric growth numbers are suddenly fighting against this acute fear about valuation.
That dual conflict is precisely the story of the week. And it really leaves investors wondering, is it macro policy risk or is it tech sector overvaluation that's going to be the main source of disruption from here?
We really have to unpack what happens when that kind of political momentum just collides head-on with market discipline.
So let's start with the macro picture. Let's focus on Japan's, it's unexpected and very rapid descent into this triple sell-off.
Okay, let's do that. And to start, let's define the trade that just completely blew up. It was known as the Takaichi trade.
Mm-hmm.
For our listeners who are maybe betting on this, what was the core promise of that trade, and why did the market just suddenly decide it was finished?
Well, the Takaichi trade was, the signature bullish bet on Japan after the new administration took power. It was really built on this one big expectation.
That Prime Minister Takaichi would pursue aggressive, really large-scale fiscal spending. We're talking massive stimulus.
Right.
And at the same time, force the Bank of Japan, the BOJ, to keep its ultra-loose monetary policy.
So keep interest rates near zero.
Exactly. The promise was something called inflationary reflation. The idea was that all this stimulus would drive up demand, inflation would finally pick up, and asset prices, especially the Nikkei, would just soar.
So the guaranteed path out of Japan's long deflationary slump.
That was the theory. The guaranteed path.
But the reality, as we saw, was the complete opposite. We saw this triple sell-off accelerate dramatically.
It did.
What were the specific damages? Since late October, across those three critical asset classes.
The damage was extensive, and it was simultaneous, which is what makes it so concerning. So first you have stocks.
Right.
The Nikkei 225 is down 7.1%.
Wow.
Then you have the currency. The yen depreciated another 2.1% against the dollar, just continuing its long slide.
And the third piece?
The third piece is crucial. Bonds. Long-term government bond yields have shot up 16 basis points. That reflects the rising cost of all this future debt.
So stocks down, currency down, and yields up all at the same time.
Exactly. And that's the market screaming, we reject this policy mix. It's just too expensive and it's way too risky.
Okay, so what was the specific final trigger? What was the piece of policy news this week that flipped the market from just being skeptical to, outright rejection?
Use the comprehensive economic package that was approved on November 21st. The sheer scale of it just shocked the market.
How big are we talking?
The government rolled out a package with $21.3 trillion yen in direct stimulus. And the total business scale, once you factor in future investment and leveraged effects, is expected to hit $42.8 trillion yen.
That is huge, much bigger than expected.
Substantially larger.
And
so the market read this not as a sign of confidence, but as desperation. As fiscal recklessness.
Okay, but wait, I still need to reconcile this because in standard economics, stimulus is supposed to boost demand, boost GDP. So why, in this specific Japanese context, is stimulating demand causing such a strong negative reaction? If we were to use an analogy for this kind of inflationary reflation backlash, say, trying to speed up a car that has a broken fuel line while it's stuck in a traffic jam, how does that translate into economic reality right now?
That analogy is actually excellent, but let's follow it all the way through because you're right. We need to deepen the critique. The market isn't just seeing a traffic jam.
Okay.
They're seeing a structural collapse in the supply side of the economy, and it's coupled with that broken fuel line you mentioned, the weak yen.
So the car itself is breaking down.
Right. Imagine Japan's economy is that car. It's already hitting severe supply constraints.
Yeah.
I'm talking labor shortages, high energy dependence, geopolitical risks to getting raw materials.
Okay, so the engine can't get what it needs.
Exactly. So if the government
Man.
then floods that system with $42.8 trillion yen of new borrowed demand, it doesn't create new supply. It just drives up the price of the existing limited supply.
Which is just inflation.
Pure inflation. And what's worse, that broken fuel line, the weak yen, means that everything Japan has to import energy, food, materials is ruinously expensive.
I see.
So this massive fiscal spend isn't actually boosting GDP growth. It's really just a debt-funded subsidy for inflation. It's why one analyst called it reflation policy under inflation.
And the currency market sees this.
The currency market sees this and says the policy actively makes the import deficit worse and pushes down real GDP. So it's ironically undermining the very growth the government is trying to create.
So the spending is seen as inflationary and debt-inducing, but not productive. And that makes both the debt and the currency toxic.
You've got it.
That makes perfect sense then why the yen is falling and the bond market is raising the price of lending money to the government.
And speaking of raising the price, the bond market, which is kind of the sober judge of fiscal stability, is sounding a truly historical warning.
How so?
The benchmark 10-year Japanese government bond, the JGB, its yield spiked to 1.700% on November 14th. It even hit 1.705% briefly.
Then to put that in context.
That is the highest level we've seen since June of 2008. It's a 17.5-year high.
That is a staggering move, especially considering the Bank of Japan has been actively capping that yield for years with its yield curve control program.
Right.
So why the sudden violent break? Is the market just daring the BOJ to intervene?
They are daring them, yes, but more fundamentally, the market is demanding a substantially higher fiscal premium.
A fiscal premium.
Yes. When these huge spending plans get announced, the market anticipates massive future debt issuance to pay for it all. So the fiscal premium is it's essentially the extra interest rate that bond traders demand to compensate them for the risk.
The risk that the government can't manage its debt or that inflation will just eat away their returns.
That's exactly. And this selling pressure was highly focused on the ultra-long bonds. The 20-year and 30-year yields both hit one-month highs.
And the 30-year was even worse.
Most alarmingly, yeah, the 30-year JGB yield hit a record high of 3.390% by November 21st. When traders are dumping 30-year bonds, they're signaling extreme skepticism about the government's fiscal health 3 decades from now.
Okay, so yields are surging, which indicates panic. But amidst all this chaos, I read that the JGB VIX index, the volatility measure for the bond futures market, was near a 1-year low mid-month. How do we reconcile those two things? Surging yields and record low volatility.
This is a classic example of paralysis by anticipation. It's a really crucial concept to understand this market right now.
Paralysis by anticipation.
Yes. That low JGB VIX is not a sign of complacency. What it means is that the big foreign institutional investors and the long-term domestic players are all essentially holding their fire.
They're waiting.
They're waiting. They believe the situation is so dire, you've got high yields, a crashing currency, this aggressive spending, that the Bank of Japan is forced to step in with a rate hike in either December or January.
Ah, so since they see the outcome as inevitable.
Exactly. Since the outcome is seen as inevitable, traders are temporarily holding back on their short-term bets. They're just waiting for the central bank to make the first move, which they expect will trigger the next huge wave of volatility.
So this forced waiting game is what's keeping the VIX index so low?
It's suppressing it, yes.
So if I'm hearing you right, the market is basically saying, we're not going to trade aggressively until the referee blows the whistle and normalizes the field.
That's a great way to put it.
So what happens if the BOJ does move?
Well, right now the market is pricing in about a 76% chance of a BOJ move by January. That would likely mean the policy rate rising to 0.75% after a quarter-point hike.
Oh.
And beyond that, the estimated terminal rate, so the expected final destination for rates in this cycle, is somewhere around 1.25% to 1.30%.
Which is, well, it's uncharted territory for a lot of the traders working today.
That's the fascinating part. Think about the average active bond trader in Tokyo right now. Their entire career has been spent under zero or even negative interest rates, with the BOJ basically guaranteeing bond prices.
They have no muscle memory for this kind of environment.
None at all.
Mm-hmm.
Most have no experience with risk management in a world where the policy rate is over 1% and the 10-year yield is over 1.7%. Once the BOJ finally moves, that artificial safety net is gone.
And then what?
Then, experts are warning that volatility could expand incredibly rapidly. It would force a massive, painful learning curve and probably a lot of forced liquidations on the entire market.
The currency market seems to mirror this broken dynamic perfectly. The yen was always the ultimate safe haven asset, right? When stocks fall, the yen should rally.
It should.
But that inverse correlation is just fundamentally broken now. How structurally weak is the yen, and why did it ignore those massive stock sell-offs this week?
It's structurally weak because the market views the government's policy as, like we just discussed, fundamentally inflationary and fueled by debt.
So it's not a safe haven anymore.
Not at all. On November 14th, the Nikkei dropped over 900 yen. On the 21st, it plunged almost 1,200 yen. And through all that, the yen barely flinched. It just kept trading near 157.90 per dollar, a 10-month low.
And it was even more dramatic against the euro, right?
Even more dramatic. The yen hit a new record low against the euro. It briefly neared 180 JPY per euro and then settled around 180.0 That's the weakest the yen has been against the euro since the currency was created in 1999.
Wow. So why does the market perceive the government as, I guess, tacitly approving this weakness, even though it's hammering the average Japanese consumer with imported inflation?
The market's interpretation is pretty clear. The government is prioritizing the export sector and the appearance of reflation over the well-being of its consumers.
Because a weak yen helps the big exporters.
It makes Japanese goods cheaper abroad, and it helps those companies bring their foreign profits back home in yen terms. And this perception was really reinforced by policy signals.
Like what?
Particularly when the Prime Minister met with the BOJ governor and urged him to report regularly on monetary policy to the Economic and Fiscal Policy Council.
Which sounds like political pressure.
It was seen as exactly that. Political pressure to maintain the easy money policy, to protect the reflationary color of the economy, which in turn just drives more selling pressure on the yen.
So the currency market is essentially calling the government's bluff on its fiscal sustainability. Did the government even try to intervene to stop this slide?
They definitely engaged in some jawboning.
Just talking, no action.
Pretty much. On November 21st, Finance Minister Katayama made some strong public remarks. He said currency intervention is naturally conceivable if the yen's decline accelerates.
And did that threat work?
It caused a temporary 5-day adjustment. The yen firmed up a little bit to 156.76, but, the effect was fleeting.
Because the underlying policy hasn't changed.
Exactly. The underlying structural policy, this aggressive spending funded by debt, that remains the heavy weight on the currency. And there's another persistent issue for global capital.
Well,
foreign institutional investors, when they invest in Japan, often don't hedge their currency risk. They just bet on stability.
a bet that's not paying off right now.
Not at all. When the yen is this unstable and weak, their profits just disappear when they convert them back to dollars. The dollar-denominated Nikkei drop this month was 9.1%. That's significantly worse than the 7.1% drop in yen terms.
So if your profits vanish when you convert them back, it creates this massive resistance for global capital to commit to Japanese stocks.
Precisely. It perfectly explains why global money is fleeing. But this whole macro crisis was also amplified by a sector-specific collapse in AI stocks.
Which bridges us perfectly into our second section.
The Japanese stock sell-off wasn't just broad macro fear. It was really spearheaded by a brutal collapse in the country's high-flying AI and semiconductor darlings.
We saw those massive drops, 905 yen on November 14th, and then an even sharper 11,198 yen drop on the 21st.
And the weight was very concentrated.
So who are the main drivers of this tech rout?
It was really the big three of Japanese AI and semiconductor plays: SoftBank Group, or SBG, Advantest, and Tokyo Electron.
Just those three.
Together, they accounted for about 800 yen of that drop on the 14th, which just shows you how reliant the Nikkei's recent performance had become on just a handful of heavily weighted tech names.
And SoftBank Group seems to be the epicenter of this collapse. How far did they fall, and what were the specific triggers?
SBG plummeted. They fell below that critical psychological 20,000 yen mark, and they suffered a cumulative decline of over 30% from their October high.
30%? That's a massive haircut.
It's huge. And this happened even though some analysts admitted the company's recent earnings reports were actually better than they had anticipated.
So why the immediate violent reversal? Especially after what sounds like positive news. What's the core reasoning from analysts for this panic selling?
Well, analysts basically identified 3 factors that caused the market to reverse what was essentially fear of missing out, or FOMO.
Okay, what's number one?
Number 1 is just good news exhaustion. The numbers were good, sure, but maybe not good enough to justify the previous exponential run-up in the stock's valuation.
The bar was set too high. And the second factor,
The Nvidia signal. SBG's decision to sell all of its remaining shares in Nvidia was widely interpreted as a profoundly bearish signal.
how so?
Traders read it as CEO Masayoshi Son believing the semiconductor upcycle is peaking, which directly contradicts his previous public regrets about selling Nvidia too early. The market sees this as the ultimate insider call on the sector's ceiling.
I see. And the third reason?
The OpenAI opacity. This is crucial. SBG's valuation is so deeply reliant on its stake in the privately held and currently loss-making OpenAI.
So there's no transparency.
None. And that lack of transparency and guaranteed profitability creates this dark cloud of investor anxiety, especially when the rest of the market is already showing cracks.
So when stocks are trading at these extreme valuations, I think I saw Advantest at 51 times earnings, Tokyo Electron at 30 times. They just have no fundamental cushion.
They have zero cushion. That euphoria flips instantly into concern over overvaluation. And the selling gets amplified by margin calls, where nervous retail investors who bought into the FOMO using high leverage are forced to liquidate, just adding fuel to the fire.
Speaking of brutal plunges, the memory giant Kioxia also experienced a stunning one, down 23%, hitting the stop-loss limit, even though it was being touted as a potential 10-bagger.
Yes, that one was a shock.
So why did a foundational memory company, one that's tied so directly to AI infrastructure, crash so hard?
The short-term trigger was simply earnings disappointment. They missed the consensus for revenue and net profit. They reported a 40.6 billion yen net profit, but the consensus was for 47.4 billion.
And for a stock that had run up that much.
For a stock that had run up nearly 10 times its IPO price, any disappointment is met with instant, violent profit-taking. Analysts call it disappointment selling.
Okay, that explains the short-term noise. But if the core underlying demand for memory and storage is booming because of AI, why is this happening? Doesn't the structural growth of AI infrastructure insulate them from this?
This is where we have to shift from the trading noise to the real structural investment analysis. Kioxia's long-term growth expectation is still incredibly robust.
Why?
Because of a massive technological shift happening inside AI servers. It's the definitive move from traditional hard disk drives or HDDs to solid-state drives or SSDs for primary storage.
And that's Kioxia's future.
That's Kioxia's future. But it's a multi-year transition. It's not a quarterly certainty.
Okay, let's break down that technological shift. Why is the old HDD model suddenly not good enough for cutting-edge AI?
This whole shift is driven by bottlenecks in computing power. There are basically 4 major points making the HDD obsolete for AI.
What's the first one?
The first is the GPU idling problem. Modern AI training uses these incredibly fast, incredibly expensive GPUs. But traditional HDDs are slow mechanical devices.
So the GPU is just sitting there waiting for the hard drives to find the data.
Exactly. The GPU is idling. It's a massive waste of computational power and a major performance bottleneck for the hyperscalers.
Okay, that makes sense. A bottleneck. What's the second point?
Well, it's related. SSDs just offer significantly lower latency and much faster read-write speeds. And these are absolutely essential for the rapid data access you need to feed modern large language models efficiently.
And third?
Power and cooling. This is huge. AI data centers face extreme power and cooling challenges. HDDs have a motor, they have moving parts, they generate more heat.
Right.
SSDs, with no moving parts, drastically reduce both power consumption and cooling costs, which is a massive financial factor when you're scaling cloud infrastructure.
And the final piece?
It's the price. Most critically, the price gap between high-capacity SSDs and HDDs is rapidly narrowing. The performance and power benefits now just far outweigh that marginal cost difference. It makes SSDs the only rational choice for new AI server builds.
I see. So what Kioxia missed consensus this quarter?
Right, and that was partly because the prior year's demand was unusually strong.
The market now sees this current drop as a bargain hunting opportunity.
That's what many analysts are saying. Management confirmed they're seeing extremely strong pull from data centers, and they expect demand to actually exceed supply by 2026. It's a classic case of short-term volatility masking an undeniable long-term technological trend.
Okay, let's zoom out from Japan to the global AI market, where skepticism seems to be peaking. We saw the Nvidia paradox this week.
Yes.
They announced an undeniable earnings beat Q3 sales, beat consensus by over $2 billion, yet their stock sold off 3% the day after. What's driving this deep-seated pessimism even when the numbers are perfect?
The market skepticism here is structural.
Yeah.
It's not about the current quarter, it's about the sustainability of that growth.
Yeah.
The concerns driving the pessimism include some major practical bottlenecks, like construction delays for the physical data centers, potential power grid shortages to even run these massive facilities. And then there's the fundamental question,
Which is,
can the hyperscalers, Meta, Google, Microsoft, Amazon, can they actually monetize their huge AI infrastructure investments fast enough to justify the current valuations?
this brings us to Michael Burry, the investor from The Big Short. He's been arguing on social media that there's a kind of accounting distortion happening with these hyperscalers, specifically targeting the lifespan of the equipment. This sounds highly technical. What's his core critique?
Burry's argument is that these large hyperscalers are engaging in some aggressive accounting. They're artificially extending the expected useful life of their key assets, mainly Nvidia GPUs and related hardware.
They're saying the equipment will last longer than it really will.
Exactly. He claims the industry average useful life for these assets has moved from 3.6 years in 2020 to an estimated 5.7 years in 2025.
Okay, that sounds complicated. Can you simplify Burry's argument for our listener? If these big tech companies are exaggerating the lifespan of these incredibly expensive GPUs by over 2 years, what are the practical financial implications? How does that affect their stock price today?
The implication is massive. It means they are artificially inflating their current profits. You have to remember, depreciation is an expense on the income statement.
Right.
So if a company buys $1 million GPU cluster and says it'll last 3 years, they expense about $333,000 annually. But if they suddenly decide it will last 5 years, their annual depreciation expense drops to just $200,000.
So their net income looks better?
Their net income looks better, and crucially, their EBITDA and free cash flow figures look better. And those latter two metrics are often the true drivers of hyperscaler stock valuations.
So how big is this effect?
Burry projected this maneuver could understate depreciation by as much as $176 billion between 2026 and 2028 for major players like Meta and Oracle. It's a way to cosmetically inflate today's profitability.
But at the expense of creating a huge future liability.
A massive one, yeah. A liability that comes due when the equipment inevitably becomes technologically obsolete or just physically fails before that extended schedule says it should.
So Nvidia's stellar earnings might be based on customers who are just kind of accounting their way to profitability rather than generating actual sustainable revenue from the equipment.
That's the fear.
That raises some serious doubts about the entire ecosystem.
Absolutely. And the skepticism is grounded in some real-world examples, like the situation in China. China is getting a glimpse of this AI oversupply risk right now.
What's happening there?
A server giant there, i.e. ICE Systems, saw a sudden profit drop, despite what looked like strong demand. China has rapidly built 150 AI data centers and has 400 more planned. But the estimated utilization rate of all that computing power is only 30%.
30%?
It illustrates the risk perfectly. Massive investment without immediate, profitable customer demand. And that is precisely the fear that Burry is tapping into globally, and it's what's driving the sell-off even after Nvidia posts these incredible numbers.
Let's shift our gaze to the U.S. market, which really provides the global backdrop for all of this. We saw incredible volatility in Federal Reserve expectations this week. It felt like whiplash for investors trying to guess the next rate move.
The whiplash was instant. Earlier in the week, the market was swinging hawkishly. But then, on November 21st, New York Fed President Williams, who's a very influential FOMC leader, he made a dovish statement.
And what did he say?
He signaled there was room for further adjustments in the short term.
Okay, and what was the immediate, quantifiable reaction to just that single phrase?
It was explosive. The market probability of a December rate cut, as measured by the FedWatch tool, immediately surged from less than 40% to around 70%.
Wow.
It triggered a massive rally. The Dow Jones surged nearly 700 points at its peak. It just shows you how desperately starved the market is for any dovish signal. Even a subtle shift in rhetoric causes these extreme movements.
But the Fed is heading into their December FOMC meeting, basically flying in heavy fog, right? They're missing crucial data because of the government shutdown. What exactly don't they know yet?
They're operating with some critical blind spots. Because of the record-long government shutdown, vital economic data points have been delayed or just canceled.
Like what?
Well, the October Consumer Price Index, the CPI report, was canceled entirely. The November CPI is delayed until December 18th, and the crucial November jobs data is delayed until December 16th.
And the problem is the meeting is before those dates.
The problem is the December FOMC meeting is scheduled for December 9th and 10th. So the Fed will be forced to make its rate decision without the most up-to-the-minute essential inflation and employment metrics.
So this profound uncertainty just magnifies the impact of every public statement from a Fed official.
It does, because the market knows the central bank is operating without a complete picture of the current economic reality.
And beyond these immediate data issues, there are two high-impact political risks tied to former President Trump that are reemerging and causing some fundamental nervousness for long-term investors. Let's start with the looming tariff uncertainty that's before the Supreme Court.
This is a massive, almost existential fiscal risk that I don't think many investors are adequately pricing in yet.
Tell us about it.
The Supreme Court is expected to rule soon on the constitutionality of tariffs that were imposed under the International Emergency Economic Powers Act, or IEEPA. The core legal argument questions whether the president, under that act, has the broad power to set what are effectively permanent taxes.
A power traditionally reserved just for Congress.
Exclusively for Congress.
So if the Supreme Court rules against the president, what is the sheer magnitude of the financial hole this creates for the U.S. government?
The financial exposure is staggering. Think tank and budget office estimates suggest these specific tariffs generate an estimated $1.8 trillion in tax revenue over the next 10 years.
1.8 trillion.
Trillion. If the ruling deems them unconstitutional, the U.S. Treasury faces an immediate, massive fiscal gap. It's essentially a $1.8 trillion tax cut that has to be compensated for, right at a time when budget deficits are already at historical highs.
So what's the market's biggest fear here?
Bank of America surveyed fund managers who fear that an unfavorable ruling would primarily lead to fiscal concerns accompanied by a stock market crash and rising interest rates.
Yeah.
The government would just have to borrow significantly more to fill that revenue void. It's an enormous non-monetary risk hanging over the market.
So that's risk one. What about risk two, the threat to the independence of the Federal Reserve?
Risk two is the direct political threat. On November 19th, President Trump publicly commented on his desire to replace the current Fed chair, Powell, when his term ends in May of 2026.
And this is more than just a political jab.
It raises very serious structural concerns about the Fed's autonomy. The fear is that the next Fed leader might be politically motivated to pursue, inflationary rate cuts, even if the economic data doesn't warrant it, simply to boost the economy ahead of future elections.
So if these two risks, a $1.8 trillion fiscal hole and a politically subservient Fed pursuing inflationary cuts, if they were realized, what would the immediate effect on the market be? Could this mirror what we're seeing in Japan?
Oh, it could easily trigger a U.S. triple sell-off.
Yeah.
Stocks, bonds, and the dollar. And potentially on a much larger scale than Japan's recent episode.
Because fiscal uncertainty and politically motivated monetary policy would just erode confidence in all three assets.
Absolutely. And this is forcing astute investors to start hedging now. Goldman Sachs, for example, is advising clients to increase positions in non-yielding assets like gold.
Which already rallied this week.
It rallied sharply this week on that perceived dovishness. And they're also suggesting potentially moving away from the dollar, as its safe haven status would be compromised by this kind of severe fiscal and political uncertainty. These are structural worries that are moving from the background right to the foreground.
As fascinating as these macro and political risks are, we need to balance the narrative a bit, because despite all this top-down pessimism in Japan, we saw a fierce signal of bottom-up confidence from corporate Japan this week.
We did.
Particularly in the financial sector. It seems like corporate action is defying the macro gloom.
That's the perfect way to frame it. Defiance. The Japanese megabanks, in particular, delivered just stellar results. They're signaling confidence that's driven by the improving margin environment and better capital management.
So the market is finally rewarding them for exiting that decades-long zero-rate environment.
It finally is.
Okay, let's start with MUFG. They provided a huge dose of good news on profitability and shareholder returns.
Mitsubishi UFJ, or MUFG, provided substantial reassurance. They announced an upward revision of their net profit forecast to a massive $2.1 trillion yen.
Which is a big jump year over year.
A strong 13% increase.
Yeah.
They also significantly increased their dividend to 74 yen annually. But the real signal of confidence was the commitment to capital return.
The buybacks.
They authorized a large share buyback and cancellation program of 250 billion yen, which is about 1% of their outstanding shares. That is, management prioritizing shareholders directly.
And Mizuho followed a similar strong path, correct?
Yes. Mizuho Financial Group announced an even steeper upward revision. Their net profit forecast is now $1.13 trillion yen. That's a 28% year-over-year increase.
And what's driving that for them?
Two key factors. Improved margins from rising domestic interest rates, which confirms the beneficial effect of the BOJ's cautious move toward normalization, and also strategic sales of their policy stocks.
And they announced a buyback, too.
A major one. 200 billion yen, which represents a pretty substantial 2.4% of their shares, which they plan to cancel in March.
Wait a minute. If the Japanese megabanks are seeing massive increases in profitability because of rising domestic interest rates, doesn't that inherently prove that the Bank of Japan's ultra-loose monetary policy, the very policy the Prime Minister wants to protect, is already functionally broken?
That is the core contradiction. You are absolutely right. The bank's stellar results are definitive proof that normalization benefits the financial bedrock of the economy.
So the government wants one thing.
The government wants to maintain ultra-loose policy to boost inflation and support exporters. But the market knows that those low rates are financially crippling the domestic banking system.
So the bank's profitability is a direct pressure point on the BOJ.
It is. It's showing that the long-term cost of zero rates is now exceeding any perceived benefit.
That's fascinating. And this commitment to capital returns wasn't just limited to the financial giants either.
Not at all. Take Toray, the materials and chemicals giant. They announced disappointing interim earnings. Their net profit declined 34%, and it missed consensus estimates. A weak result.
But their stock rallied.
Their stock rallied sharply, up over 10% on the day. And it was solely driven by the announcement of a massive 50 billion yen share buyback and cancellation. That's 4.2% of their shares.
So the key takeaway here is pretty potent.
Very potent. For many of these large Japanese companies, the commitment to large buybacks is currently viewed by the market as a stronger signal of management's confidence than any short-term earnings miss.
Capital returns are king right now.
They're overriding everything, even the macro concerns.
Okay, moving over to the consumer side, we saw some interesting pockets of strength reflecting these persistent post-pandemic and wealth effects, especially linked to tourism.
Yes, MTG, the beauty and wellness company, seems very focused on inbound foreign tourists.
How are they doing that?
They are strategically repositioning. MTG, they're known for the Rifa brand. They saw their stock rally based on expectations of record profits this year, and their big strategic move was opening the Rifa Ginza flagship store on November 15th.
And the goal there is explicit.
Very explicit. Use the high-profile Ginza location to attract high-spending inbound foreign tourists, which is a critical market, and then leverage that prestige to revive their struggling overseas business.
So it reflects this continued confidence in the weak yen driving luxury tourist spending.
It does. And we also saw an unexpected spike in resort membership prices, which confirms that wealth effect in Japan.
How big a jump are we talking?
The average price of resort memberships jumped a significant 8% to $3.58 million yen. That's the fifth consecutive rise.
And what's causing it?
It was rush demand. It was ahead of Resort Trust's planned December fee increase for name changes. This fee hike, at 110,000 yen increase, it triggered a surge of affluent investors just buying up these assets now.
And that's compounded by the rising stock market.
Compounded by the general effect of the rising Nikkei index boosting overall investor wealth, which then translates into spending on these luxury experiential assets.
And finally, let's briefly touch on staple goods, like rice, to give some context to the consumer inflation experience that the weak yen is driving.
The inflation picture for basic goods remains very challenging. Rice prices saw a slight dip week over week. They dropped about 1.3%.
But year over year.
But, and this is the vital context, prices remain a staggering 22.2% higher year over year.
Wow.
This firmly keeps staple goods inflation a daily reality for Japanese households. Prices have been consistently above the 4,000 yen mark for 11 consecutive weeks.
And this contrast between the financial sector's profitability and the household's cost of living is really the defining tension of Japan's economy right now.
It absolutely is.
So we discussed the collapse of the overall Takaichi trade, but let's quickly review which specific policy-linked stocks managed to retain their gains and which ones were just abandoned.
Right. The initial phase of that Takaichi rally was built on speculation of massive infrastructure and defense spending. The sectors that kept their gains were the ones where that policy speculation amplified already strong underlying fundamentals.
So who were the long-term winners?
Shipbuilding Toyo Engineering was up 30%, Nomura Shipbuilding up 17%, and construction. Taisei rose 24%, Kashima was up 22%.
And why them specifically?
Analysts noted that the construction sector is benefiting from stronger underlying profit rates. They're prioritizing higher margin specialized projects, which makes them resilient to political volatility. The infrastructure spending hoax just added rocket fuel to a sector that was already performing well.
And which sector saw that rapid abandonment?
The losers were primarily defense stocks and the inbound or China-sensitive names. Defense stocks like Mitsubishi Heavy down 13% and IHI down 7%. They saw major profit-taking after their massive earlier runs. But more significantly, the inbound and China-sensitive stocks suffered because of fears over deteriorating Sino-Japanese relations.
So companies like Shiseido.
Shiseido plunged 22%. J-Front Retailing fell 5%. It was all driven by concerns over Chinese consumer sentiment and reduced tourist spending. This really shows that geopolitics is acting as a major headwind for any company that relies on Chinese consumers.
Okay, let's transition to a truly long-term theme. The race for zero dead zones in communications. It seems the competition among Japanese carriers, KDDI, NTT, SoftBank, Rakuten Mobile, is rapidly shifting its massive capital spending from land infrastructure to the air and space.
This is a fundamental structural investment shift. It's driven by national necessity, things like disaster preparedness, and also just massive commercial demand.
So the goal is seamless connectivity everywhere.
Seamless connectivity in mountainous areas, remote islands, and crucially, during disasters when all the ground infrastructure is compromised. This is an existential play for these carriers.
And KDDI seems to have taken the early high-profile lead here, using a very famous partner.
They did. KDDI launched a direct-to-smartphone data service using SpaceX's Starlink network. It's compatible with the iPhone 13 and later models.
And it's free for now.
For their subscribers, it's currently free, which demonstrates their commitment to securing this crucial technology first. This move gives KDDI a significant competitive edge in offering immediate, reliable service in historically unreachable areas.
So what are the deep-pocketed competitors doing in response to this?
Well, they're leveraging their own global partnerships. NTT is strategically tied up with Amazon's Project Kuiper, which aims to cover the globe with over 3,200 satellites.
And Rakuten and SoftBank.
Rakuten Mobile is working with AST Space Mobile. They're aiming for commercialization by 2026. And SoftBank is working with Psy and Eutelsat, also aiming for direct-to-smartphone services by 2026. The market is really divided between Starlink, Kuiper, and AST, and the Japanese carriers are just aligning themselves strategically.
So beyond consumer use in disaster zones, what's the significance of this shift in terms of long-term capital spending and competitive strategy for these giants?
The significance is massive because it touches all the high-value commercial sectors. This infrastructure is vital for construction sites, for logistics operations, for shipping.
Can you give an example?
Sure. MOL, the major shipping company, is actively adopting Starlink for true welfare. They acknowledge the high demand for reliable, high-bandwidth connectivity at sea. So this isn't just a consumer defense, it's a massive growth play into vertical industries.
And they're also complementing satellites with something called HAPS.
Yes, HAPS high-altitude platform stations. These are essentially solar-powered drone base stations that are placed in the stratosphere about 20 kilometers up.
And what do they do?
They offer high-capacity local coverage, reaching up to 200 kilometers. This provides the local density that satellites often struggle with. Both NTT Docomo, with Airbus, and SoftBank are heavily investing in HAPS technology.
So the strategic deployment of both low Earth orbit satellites and these stratosphere drones will determine the winner of the next generation of connectivity infrastructure.
That's right.
Okay, finally, let's wrap up with a quick look at how the energy markets are evolving, both domestically in Japan and on the global stage, reacting to this week's news.
On the domestic front, we saw a really critical structural development in Japan's energy trading. JERA Global Markets, which is a subsidiary of Japan's largest power generator, JERA, they became the first major Japanese utility, one of the established old electric companies, to gain trading qualifications on the Tokyo Commodity Exchange, or TOCOM, for electricity futures. This is a monumental step.
And why is JERA entering the futures market so significant for Japan?
It's expected to significantly boost the liquidity and the transparency of Japan's power trading market, which has historically been dominated by these opaque long-term contracts.
So this signals a big shift.
JERA's participation signals a willingness by the major players to embrace modern, transparent market mechanisms. And that should improve price discovery and risk management for the entire energy sector, which will eventually make the energy supply more stable and efficient.
So that's a structural change for Japan. How did global commodities react to the geopolitical shifts this week?
On November 21st, we saw these really contrasting movements, and they were dictated primarily by either geopolitical fear or Fed speculation.
Let's start with oil.
Crude oil, WTI, it fell 1.59%. And this was a direct reaction to reports of a new U.S. proposed Russia-Ukraine peace plan.
So the market fear was about increased supply.
The fear was that if peace negotiations proceeded, Russia's oil supply, which is currently constrained, would increase. That would ease global supply constraints and push prices down.
And what about gold?
Gold rallied sharply, settling at $4,079.79.05 per ounce. This is a classic reaction to dovishness.
From the Fed?
Exactly. New York Fed President Williams' comments, which reignited those expectations of a December Fed rate cut, immediately made non-yielding assets like gold significantly more attractive compared to yielding assets like bonds.
Okay. This week provided an extraordinary view into how macroeconomic policy and technological valuations are just fighting an internal war.
They really are. And if we look back, two defining conflicts really emerged from our sources this week. First, you have that clash between the Japanese government's aggressive fiscal policy,
pushing that massive $42.8 trillion yen economic package,
and the market's demand for immediate fiscal restraint. And that clash created the painful triple sell-off falling stocks, rising bond yields, and a weak yen that threatens to just unravel the entire Takaichi trade for foreign investors.
And the second conflict.
Second, you have the ongoing tension between these undeniably strong AI growth numbers, confirmed by Nvidia's performance, and that structural shift toward SSDs, and the very real fears of an AI overinvestment bubble.
Fears that are amplified by Michael Burry's highly technical critique of accounting practices, questioning whether the current profitability is even genuine.
And that chilling precedent of massive oversupply that we're already seeing in China's data centers. It's a real warning sign.
So you have political will pushing one way and market discipline, particularly in the bond and currency markets, pulling the other way with frightening force.
And that leads us to our final provocative thought for you, the investor, to consider as you prepare for the weeks ahead.
Will the bottom-up strength that we're seeing in some of these key sectors, the financial institutions making massive share buybacks, the robust construction sector, the continued high corporate earnings, will all of that give the Takaichi government the political confidence it needs to continue its aggressive fiscal path?
To ultimately ignore the stark warnings that are coming from the bond and currency markets?
Or, conversely, will the willingness of politicians to respond to the stock market's optimism rather than the more technical long-term warnings from the bond and currency vigilantes lead to the very hyperinflation and fiscal crisis that the market is already signaling?
The disconnect between those corporate profits and the macroeconomic policy has just never been sharper. That willingness to prioritize the stock market over fundamental stability is the key variable here.
Indeed. Thank you for joining us on this deep dive. We are committed to providing the most accurate, valuable, and timely information and analysis.